What's going on, everybody? I'm super excited for everyone to meet our guest today. I just learned that she watched some of our real estate ride-along shows, so maybe one of our first fans. But more importantly, if you are a female out there, not trying to be sexist, but if you're a female out there and you are maybe a mother, have a full-time W-2 job, or just have a lot of things going on and you've always wondered, how do I get into commercial real estate? This episode is going to be for you. Our guest today, Kelly Iannone from Orlando, Florida, has worked for Walt Disney for over 18 years. Her and her husband started investing in the last 3 or 4 years, have done 3 syndications. She's worked a full-time job and super impressive. We've been talking for, I think, over a year.
Yes.
And I've really wanted you on this show. So welcome to Denver and welcome to the show.
Thank you very much. Excited to be here.
Yeah, it's going to be amazing. And it's a little bit colder than Orlando, I'm guessing. But it's warm in the studio, and we're going to have a great conversation. Take us back to the beginning, your family, where you grew up, what it was like growing up, and maybe the context and the relationship your family had with money.
So I originally from Michigan, I believe you mentioned that. And I grew up in, quite frankly, a very idyllic life. I lower middle class life. My parents were factory workers. We were very financial literate, or my parents were very financially literate, but with a very traditional path. So they worked in the factory. They invested in their 401ks. They had a pension.
Wow.
But they knew the value of money. They did work around the house, but we also had plenty of things. We vacationed and so on. But they knew the value of money. And we talked openly about money in our household.
Wow.
And so I was very familiar with mom balancing the checkbook every month, budgeting for vacation. And when I was a teenager, I actually got my first credit card with it being a tool to learn the value of money and that you can't just max out a credit card. You have to pay back immediately whatever it is that you put on the credit card. So I was very fortunate from that perspective to be taught financial literacy at a young age.
That's incredible. Most people that come on the show don't have that kind of background and relationship with money. So when you say financially literate, like give me a couple examples of how you observed your parents being financially literate and how that was passed on to you. Like so they were balancing the checkbook, they gave you a credit card. Like, I don't know anyone in high school that got a credit card. So they were obviously, what was the point of that? They were trying to give you credit early on so you could,
They knew the value and the importance of having a good credit score. And we talked about it. So having the ability to have a credit card established my credit score at a very young age, which is one of the big factors in determining your credit score.
Right.
So again, that was one of those things. So when we went to the mall, I might buy a pair of jeans or something on the credit card, always with permission.
Right.
But it was a tool to teach me that.
Amazing.
Additionally, when we think about the skills, my parents, because they worked in a factory, they were able to work overtime.
Wow.
So I remember having very intentional conversations about Dad's working this weekend overtime to save up for our vacation. We came to Florida every year. And so those were very intentional conversations about, okay, we want to vacation. Therefore, they work overtime in order to budget for it.
Wow. Amazing. And where do you think your parents got that from?
That's a great question.
Because most people that I would say, not to put people in a box, but I would just think most people, I'm from the Midwest, and most people I knew in the Midwest did not really understand money that were in that kind of economic class, right? I mean, most people in a factory, I wouldn't think understand credit, understand the value of saving, how to budget for family vacations. Where do you think they got that from?
Honestly, I don't know. That's a great question. I haven't really thought much about it. I don't remember my grandparents on either side of the family having any financial difficulties beyond not having a lot of money.
Right.
Like my mother recalls growing up relatively poor. My grandfather used to drive by the gladiola fields in southern Michigan on his way home, and he would cut Florida after the season. He would be able to go out there and cut whatever gladiolas were left in order to take home to my grandmother.
Right.
So scrappy from that perspective, and so they didn't have a lot of money, but I don't know that there were any really big life lessons of where they necessarily taught that from.
Super interesting. And did they ever talk about real estate? Did you understand mortgages and debt? Did you guys talk about banking?
Yeah, we did talk about banking as well. Would go to the bank with them in the town. Interest rates right now are higher, but I very much have been aware my entire life about how high they were in the 80s when they built our family home.
Right.
And having, I think
they were like in the 15 to 18% range. Yeah.
Yep. So I knew that. But I think what was really impactful to me in my early years and certainly early in my adult years, is that the misconceptions with real estate, my parents were not real estate investors. And so what I heard at home was that all landlords are slumlords and tenants destroy all the properties and real estate is really risky. So that was something that I heard growing up and had to kind of work through as I got older and more interested in investing in real estate.
Yeah, it's so interesting. Like when I grew up, I was never understood that anyone in our neighborhood or socioeconomic class could ever afford real estate, right? And I don't think that the rhetoric or the thought of real estate was like it was a great investment either, right? No one that I was around was ever like, oh yeah, we should own real estate, right? I mean, I think people were talking about owning stock back then, and that was what people talked about, but no one was really talking about real estate. And it's kind of interesting and ironic how that's changed, right? I think most people today would say, real estate is the least risky asset class with the most upside.
Agreed.
So walk me through from that standpoint in high school, getting your credit card, understanding credit, understanding banking. Walk me through when the light bulb went off and the paradigm shifted for you of wanting to get into real estate and you thinking that this was like the path for you.
So there was a solid 10 to 15 years that went by. And during that path, I was going to follow the traditional path, get a good job at a corporation, work until I was 50 or 55, retire with the pension and my 401k. That was the path I was on. I was going to be a corporate executive. And I've had a very successful corporate career, but I realized about 6, 7, 8 years ago that I didn't necessarily want to spend the next 15 years working in that corporate environment. And my husband and I had a moment where we realized we weren't saving enough for retirement in order to retire at 55 anyways. So we really dove into the FIRE community movement, which I'm sure you're familiar with, Financial Independence, Retire Early. And through that and our further education on financial literacy, real estate really came to the forefront of an optimal investment. And he came from a family that was focused on real estate, but not a lot of real estate investing and financial literacy background. And so we together then decided real estate was our avenue and started exploring, found BiggerPockets, started listening to podcasts, engaging in the forums. A few years ago, the Real Estate Ride-Along show that you mentioned, which really opened the door to real estate being attainable and not something just for the wealthy, and demystifying what I had heard growing up, that real estate was really risky and tenants just destroy properties and all landlords are slumlords. I saw a different side. And so at that point, we realized we wanted to, one, be able to live on one income and invest the other income aggressively into real estate so that we could grow our portfolio and be work optional at a much younger age in our mid-40s.
Yeah, it's amazing. So I want to take a step back a little bit because let's talk about your tenure at Disney, right? You work for Disney, one of the top companies in the world, right? And you've been there for 18 years.
Yep.
And by the time this podcast and conversation releases, you will have resigned from Disney, right? You're resigning in Q1 of 2023. And so talk a little bit about, that run there, because I think there's a lot of people in the audience, a lot of females in the audience that probably are the same thing, corporate executives on their way up the ladder and maybe realizing there might be a better way for me to, get more fulfillment, enjoy my family more, and reach financial independence faster than waiting until I'm 55 and getting a big, pension or 401k payout.
Yeah, absolutely. It's an evolution. As we grow, we evolve. And as we learn things, our mind expands and we grow. My first 10 years of my corporate career, that was what I thought I was going to do the entire time. And only when I started realizing and exposing myself to so much more, I realized I could do more than just work until I was 55. And a lot of people are going to work till they're 65. My corporate background, I've worked in strategy roles, business planning roles, as well as finance and forecasting and planning, which lends really well to what I'm doing now in commercial multifamily because we're continuously evaluating deals, putting together business plans on how we're going to execute it, and then executing it. But it was quite the journey, and it's still a mind shift struggle.
Right.
I am excited for this next step of my journey, but I'm also really scared and nervous to think about walking away from what has always been ingrained and is widely discussed as a very stable, right. Exactly. But the reality
and desirable, company, right? I mean, most people that are at Disney are like, yeah, I'm set.
And everybody knows the Disney brand and everybody want to work for Disney. And it's great. It's been a really great company for me to work for, but it is a company and I am fulfilling somebody else's mission. And it is very, it's very focused on how do we drive shareholder value like any public company.
Yeah.
And there's just so much more I can provide for me and my family. And I have a passion to help others achieve financial freedom. In what I'm doing in real estate allows me to help others generate passive income.
Yeah, I mean, like the CEO and the board at Disney is not waking up and saying, how do we help Kelly and our other, long tenured employees reach financial independence and build wealth? They're trying to figure out how do we get more out of Kelly and everyone else, right? Which is fine. I mean, that's how most companies
that's the business.
But that's the business, right?
Yeah.
And I think, the more this conversation is had, I think the more people, their eyes open up to there's other ways and maybe some better ways or complementary ways to get to where I want to get to financially. So let's dive into, BiggerPockets, right? This is the Multifamily Mentor Show on BiggerPockets. I mean, I learned so much when I started out in 2013 and 14, trying to get out of flipping and transition into multifamily, and talk about how, podcast and media and YouTube really helped you, fast track your journey into getting to where you're at now.
It gave me the community. I wasn't surrounded by people that were doing real estate, that were talking about real estate, or that were even talking about retiring.
Right.
So listening to podcasts, going onto the BiggerPockets website, going to the events page and finding a local meetup group. I did that 5, 6, 7 years ago and religiously went monthly for several years while I explored different niches. And that allowed me to then meet other people in my community that were doing different things in real estate from an investing standpoint. And as I discovered what was more of an interest and aligned with my goals, I was able to then dive down into specific podcast, YouTube channels in order to dive deeper and make it more relatable and achievable for me.
Yeah.
And even even interacting with folks on social media. So I'm on the LinkedIn platform a lot, and that's how we connected. Thank you.
You're fantastic on LinkedIn.
And it was a mindset shift for me to realize that my company, the business I worked for, didn't own my LinkedIn profile. That my LinkedIn profile is a social media platform about me, and I am more than just my corporate job. And pushing real estate on there and really making my profile and what people see there about what I'm doing in real estate as opposed to what I'm doing at the Walt Disney Company, which is great. But what really drives me and what I'm passionate about is helping other people generate passive income through real estate. And that's how I'm able to do it.
Yeah, amazing. So, I think one of the things that I think is interesting about your story and your situation, what were the conversations like with your husband, right? When you're like, you have this great job, you guys, dual income, and, what are maybe some tips for some other married folks out there, females that have a great job, and they go to their husband and say, hey, what was that conversation like? And what's your advice for other females out there that want to do the same thing? How did you go about doing that?
It's evolved over the last couple of years. So we have both been on the same page about investing in real estate. And real estate was really his dream.
Oh, wow.
He exposed me to it.
So it was his dream first.
It was his dream first.
Oh, cool.
I am a type A personality driver, strong woman. We talked about that. And I was one that once I realized the benefits of it, I ran with it. So it was ultimately his dream first, but I am the front of the business and driving with it because that's just my personality. I'm carrying the torch. Yes. And marriage it ebbs and flows. It's not always 50-50. So right now I'm here in Denver. He's at home with the kids, keeping the family running. And that happens in our business. So we're aligned in what our goals are and what our values are and where we're going. And then the conversation around stepping away from a well over 6-figure corporate job was...
Especially with kids, mortgage responsibility, Orlando's not cheap, Florida's not cheap, inflation. Yeah. What was that like?
All those factors. Yeah. It's hard. It's challenging, but it's the right time because we know that having a corporate job does not equal security.
Right.
He also works for the Walt Disney Company.
Oh, wow.
So when we think about COVID, furloughs, he was furloughed for 14 months.
Oh, wow.
But because we were in a position of living on one income, we were able to continue to invest in commercial multifamily and acquire a 6-unit during that period of time. And we've set ourselves up for success. So we recognize that just because we both work in the corporate world doesn't mean that we're secure. Anytime, we're potentially going into a recession, we might be whatever the conversation is. We work for a company that has highly discretionary driven spend.
Right.
And so it is a very specific decision. This last year has really been a proof of concept for me. And driving these multifamily deals, raising capital, being on the asset management side of it. How does that translate into financial benefits for our family as well as our investors? And the proof of concept has been successful. So that's really what's driving this change. And then knowing, I think Mindy Jensen loves to say that what's the worst case scenario? Go back and get a job.
Yeah, and you're going to be very hireable. Yeah, and that's not going to happen.
That's not going to happen.
So let's start talking about deals then, and let's get into real estate. So talk about your first real estate investment. What was the first deal you and your husband did?
My first one ever was a single family.
Okay.
And it was our prior primary residence.
Okay.
That I had bought early 2004, 100% financed, 80-20
You bought your first
loan.
house in 2004?
Yes.
Wow.
Personal house, not an investment
property.
property.
Your first personal house.
We converted it into then a rental property, which we still hold today.
Oh, nice. And how much equity do you have in that thing?
Oh, a couple $100,000.
Couple hundred. And you HELOC and then use that to invest in other properties?
We actually haven't.
You haven't tapped it?
It's risk reward and we're just not comfortable. Right now, we really like having that money there.
Got it.
We have a big dream. I have a big dream of sailing around the world and buying a catamaran, which are not cheap. So potentially that HELOC will be used to buy a boat.
For the catamaran.
Maybe, yeah.
Oh, okay. Nice.
But first we have to get everything else set up. But no, that money's still sitting there. We do have a small HELOC on our primary home.
Okay. Got it.
But it's all about, and that's part of having a husband, their conversations. What is our comfort levels from a risk reward perspective?
Yeah, got it. Okay, so that was your first deal.
Mm-hmm.
That was your first transaction. Sounds like that was a winner, a big winner.
Yes.
Like, what did you buy it for and what's it rented for?
Oh, well, bought it for $220 back in 2004.
Got it.
Before the financial crisis. We rent it currently for $1,850, but market rent is closer to $2,100.
Yeah, but you keep it filled and you probably have a good tenant in there. Okay, so talk about your first. So that sounds good. I mean, that's still a win. Your first single family home. Talk about your first multifamily deal.
Yeah, so our first multifamily deal, we went from having single family to a 6-unit building.
Okay.
That is about 40 minutes away from our house in Central Florida. It was completely being underutilized, not taken care of. That quite frankly, was a slumlord that owned it previously. And we really care about, we want our residents to have a nice, safe, clean place to live. So we were able to acquire the asset at $325,000. We ended up putting about $300,000 into it.
Wow. You doubled the purchase price in construction.
Yeah. If we would have known that, maybe we would have done the...
Burr?
No, the zone. We did burr it.
Opportunity zone.
Opportunity zone. Thank you.
Right, yeah, you can double the basis.
Exactly. If we would have known we were going to put that much, then that might have been a good program for us.
But you didn't go into it thinking that.
No, we thought we'd do 220.
You and your husband, or do you have partners in that deal? Just
this
you and your husband?
This is just me and my husband.
Wow. So talk to me about that deal. How'd you find it? How'd you source? I mean, because finding your first multifamily when you haven't acquired before is not easy. So how did you find that deal?
We found it on MLS. So my husband is actually a licensed realtor.
Oh, got it.
He does not work as a realtor, but he has his license. So we have MLS access. We found it there, and one of our colleagues who we know from our local real estate meetup has shown the property a few times and had some additional information on what offers had been been denied and stuff. So we ended up using that realtor to make the offer because it just enabled us to have a lot more information.
Right.
We offered, we used a hard money lender, so we offered cash, 21-day close, no inspection.
Wow.
We drove through the exterior.
Your first deal, you did no inspection?
We did no inspection, but I will add that the general contractor who we had known previously and who we were going to use on this project had walked 3 of the 6 units, and we had seen videos of them. And this property needed everything: windows, air conditioning, new electrical panels, new flooring, appliances.
So you went in thinking you were going to spend $300? Or was that a surprise?
We went in thinking we were going to spend $220.
$220.
And we spent $300.
20 or 30% over budget, right?
Yeah.
So I mean, that's pretty. Who gave you that advice to go non-refund or to go hard 21-day close on your first property? I like the aggressive move, but you don't hear that very often.
I wouldn't say anybody gave me that advice, but having seen the market,
you just feel like that's what you had to do to get a deal.
Yes, and we knew this property needed everything. It needed a new roof. It needed everything.
Okay.
So the risk of what else would be found was minimal.
Got it. Okay, so you're into it for $600, and what are the rents?
We're renting it at $6,500.
Oh, good.
Is total rents.
Yeah, so about the 1%.
So not a home run, but we did refinance out of that hard money loan, and we were able to pull some of our capital back out.
Okay.
And we put about $250,000 into that deal to start.
So you've already refinanced it?
Yes.
Oh, nice.
Yeah.
So it's stabilized and cash flowing.
Stabilized. It's cash flowing. All the original residents are still in there.
Do you guys manage it personally, or do you have a third party?
We have a third party property manager.
And how's that going?
It's going pretty good. There's some work on the maintenance side. We get some maintenance calls that I think could just be handled.
Right.
So it's a process there. Part of it is we had the entire building done. The general contractor works a lot in that particular area. So there's some issues that we then send to the general contractor to go back and fix versus sending to just your normal maintenance process when you're holding a property.
Okay, I'm enjoying the real estate talk here. So what was your next deal?
Our next deal was 136 unit syndication.
From 6 to 136.
Yeah.
Okay, walk me through that process.
Yep.
How did you get into that?
So this is a real estate syndication, and I had this limiting belief I couldn't do syndications because I had a full-time job.
Yeah.
So I really started networking, made some connections with folks on LinkedIn, went to some area multifamily conferences, met folks in person, found a team that was just building up. They had some experience doing deals on their own, but they were putting together a team. And I was able to plug into that team and bring my background and experience.
How'd you meet the team? So if someone's out there and they're like, I want to do the same thing, like what were the steps that you took to meet them and get connected and be on their team?
I started engaging on LinkedIn with
LinkedIn.
people, operators on LinkedIn, set up time to talk, had conversations with them. When we met in person, additional conversations. I am a go-getter, am type A personality. I'm like, hey, put me in, coach.
I can see that.
Put me in, coach.
Yeah. I'm getting that. Yeah.
Give me a chance. And that was really my attitude from this. Like I hadn't done that. I hadn't done a syndication that large of a deal, but I had the 6 unit, which was invaluable. You don't have to do a small deal like that on your own before you get into a syndication. But I have always said that I don't think I'd be where I am today if I hadn't done that because I had all this experience. And so then it was finding partners that we aligned from an ethics, a transparency, and the type of deals we wanted to do. And they were just getting started on a 136 unit property in Tallahassee, Florida. And I had the opportunity to come in on that deal, work on raising capital, handle investor relations, as well as be on the asset management side.
Yeah, all while working a W-2 job.
Yep.
And having children.
Yep.
Wow. And very impressive. So what was that, raising capital, super hard, right? I mean, so many people talk about it and it's getting harder, in the current climate. So what was that like for you, raising capital while you're working a full-time job? I mean, paint a picture for the audience of like how, when you're making calls, how you're making calls, what the response was like, how did you handle rejection?
So you hear a lot of no's, and that's okay. I'd rather hear a no than be ghosted all day long. Just tell me no. But
yeah, it's like how quickly can you get to a no?
Exactly.
Really what you want to
exactly. Because you're going to go through 100 no's before you get a yes, and that's okay. It's not right for everybody. My process.
So you have pretty thick skin then.
Yeah.
So it didn't phase you to get 100 no's.
No. I think that kind of going really back early in my corporate career, I used to work in sales for Disney. I sold meetings and conventions. And let me tell you, selling something at Disney is pretty darn easy. Everybody loves Disney. But you still learn to make cold calls, call on different companies, and you do get told no. And it's usually a pricing sensitivity issue. But raising capital for me really came down to putting myself out there on LinkedIn and sharing my story. I have not raised capital from my family. I do have some friends that have invested in particular deals, but it's really me putting out what we're doing on LinkedIn and sharing our story and empowering other people to really think intentionally about what their financial goals are and how they are working towards achieving that or not, and having those conversations. So I love getting on calls with potential investors, either a phone call or a Zoom call. And doing it while I work a W-2 job is a lot of work.
Yeah. So what were you doing at night? You put the kids to bed and then get on Zoom?
The night, the weekend, before work, some lunchtime. Sometimes I have an opportunity.
You're getting it in.
Yep. Any minute I'm getting it in. I have a Calendly link that people can go on and schedule a call. And of course, I've scheduled those around other meetings that I have or early in the day. But it's a lot of burning the candle at both ends, which is how my husband and I have now gotten to the decision that it's time for me to take that step away from my corporate job. And it's really then having my spouse and I on the same page, because when I'm on calls with a potential investor at 6 p.m. in the middle of dinner time, he's taken over the kids. Yeah.
Incredible teamwork.
So really time management is super important.
I feel the same way with my wife. My wife does that a lot. Yeah. It's like, I got to do, yeah. Anyways, teamwork is key.
Teamwork is
huge
key
when you're married. You got to divide and conquer. So that first deal, how big was the raise?
136 unit rate, or 136 unit. That was about a $7 million raise.
$7 million raise. So you went from a $600,000 sixplex to a $7 million raise.
Yes.
Okay.
I obviously did not raise it all.
Right. Yeah.
It's a team
still
sport.
A great experience. Yeah.
Great sport.
Okay. And so you guys closed on the deal.
Mm-hmm.
Okay.
Yep. We closed on the deal the very end of last year. So I've learned a tremendous amount just being in that deal over and above what I did in the 6 unit.
So that was 2021, the end of 2021.
End of 2021. It was 100% vacant. We have gone through renovating all of the interior units and the lease up. We are 72% leased, 80% pre-leased, and we're hoping to be stabilized in the 90% by the end of December.
Wow.
So it's been a tremendous experience, and even communication with investors when construction gets delayed a little bit, or we miss the summer lease up period because of the construction delay. Here's what we're doing to get more traffic and convert that traffic into signed leases so that we can stabilize the asset.
Yeah, one of the things I really enjoyed about our first phone call was, just how intentional you are about being transparent with investors. So talk a little bit about that. We got a couple minutes left here. So talk about where that desire comes from and the importance of being very transparent, even when things are not going well. Because let's face it, in the last year, there's been a lot of bad things that have happened, right? Interest rates have gone crazy. There was inflation. Now rents are going to start coming down. The economy is really tight. Yeah. People have less liquidity, less disposable income. And, interest rates rose faster than anyone thought, which wiped out a bunch of people. I know several operators that have gotten crushed. They had floating rate debt, didn't have a rate cap, really, really bad stuff. And I think what you touched on is so important. So expand on that.
Transparency has always been a key driver for me in my corporate experience. And of course, in real estate, it is. I like to give people the benefit of the doubt that you can process the information you're going to receive. And I think it's also hugely valuable in order to have that authentic conversation is kind of how I put it. In experiences that I've had throughout the year, when something doesn't go right, it's how we recover from it that really solidifies the relationship and the partnership. So when we have things that aren't going great in a particular deal, or we're not on pro forma or the timeline, it's communicating that in our monthly communications to our investors. And I've got some investors who will pick up the phone then and call me and be like, talk to me a little bit more about that. And they wanted to dive in. I am a resource to my investors, and I'm transparent, and I want to share whatever level of information that they're looking for. But transparency is super key. That's one of my challenges and struggles with investing in the stock market, is the information you have access to is what is required by the SEC and earnings reports. And that is a very curated conversation of what we need to show at a particular point in time. So transparency is by far one of the biggest values of mine when I'm doing a deal.
Yeah, I think that's such a huge thing. One of the things that I learned early on was, good news is going to get there on its own, but I want to be the one delivering the bad news. Totally. And I want to say it first, and I want to get out in front of it. And it's a long horse race, right? And so when you're dealing with people's money, right, besides their children, that's like the most important, kind of sacred thing to most people in the world. And how you care for that money, how you communicate when bad things happen, and when you don't meet their expectations, right? That's really the sign of someone that's going to really make it and grow, I think, in this industry, in the game of investing your capital and other people's capital. So I think that's a really important thing. All the young syndicators out there, all the people getting started, I think that's something you can really learn a lot from Kelly and how she's done that. And, check her out on LinkedIn and watch her transparent communication, watch how intentional she is about delivering the news in a really data-based way and not trying to sugarcoat it. I think that's the key, is like, if there's bad news, I just want to say it. Hey, here's what it is. We missed the NOI this quarter by whatever percentage, and here's how we're going to adjust in the next quarter. So as we wrap up, one of the best things we talked about was picking partners, right? So many people that get started, they're on a team and they have a role, someone else has a role. How do you, and you've been in some partners, maybe not so great, and some other ones that are really good. So what is your advice? Give 2 or 3 pieces of advice to young operators out there or young females out there that want to get in the game on how to pick partners and your team.
When you're looking for partners in your team, you want to make sure that you're understanding their track record and how they've gone full cycle and if they've achieved the returns that they had projected early on, as well as talking through how they are having those transparent conversations with investors when something doesn't go correctly. Those are 2 key things that we want to have the conversations about when we're looking at picking partners, because there's a lot of JVing in the syndication space, as well as joining teams to raise for, do asset management for, and investor relations for.
Yeah, I think it's so key, just to like bring it home, is understanding, what is their track record? Tell me every deal you've bought and sold and how it's going. Like, I want to hear the good, the bad, and the ugly. Tell me everything. And what are the priorities, right? How many other deals are you working on? And how do you view caring for investors' capital? Because not everyone views investors' capital the same way. There's so many people in the industry that I know that are more like, specialize in acquisitions, but don't really care once the deal's closed, right? And so you've got to be extra careful. And I think interviewing and really underwriting who you're going to partner with, because once you're in that deal, your name's on the line.
Totally.
You know what I mean? Your name's on the line. So let's give a shout out to your husband. What's your husband's name?
John.
John. Shout out to John out there holding down the fort. And what are the kids' names?
Fiona, Weston, and Ava.
Fiona, Weston, and Ava. And what ages?
7, 8, and 15.
7, 8, and 15.
Yeah.
Fiona, Weston, and Ava. Your mom's crushing it on YouTube. Anything. So how do people get a hold of you on LinkedIn?
Yeah, so you can find me on LinkedIn just under my name, Kelly Iannone. And probably the best place to get a hold of me also is through my website, www.waypointcip.com. I have some great resources on there on what to look for when you're looking at particular deals or partnerships. So make sure you check out the resource. Yeah,
it's been a real pleasure. I can't wait to continue to watch your journey. And I'm really stoked for you. And I think you're a rock star.
Awesome.
And I think you're really inspiring the next generation of females, which really gets me fired up because that's what we need.
A lot.
So great work today. Thank you for being here. And make sure you share, like, and leave a comment on the episode for Kelly. Thank you.
Thank you.